Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
We're so focused on trying to focus on this secret language of dividends that's telling you the most reliable clue so that you can actually hold and stay the journey rather than have this big gap between how the underlying investment does, which might have been very well selected, and how long you're actually able to stay along the journey.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How can dividends play a key role in your portfolio returns? And why does a focus on dividends calm your investor psychology and can increase your portfolio resilience? Today I'm joined by Jonathan Nurick, CIO and founder of DivGro. G'day, Jonathan.
Lovely to be here. Thanks, Phil.
Thank you very much. So in 2019, Jonathan co-founded DivGro, an investment fund built on the same philosophy his family office has applied for decades. His father, Matthew Nurick, was a director at the prominent London-based hedge fund Momentum Group. The fund's approach is rooted in academic research led by Myron Gordon, father of the Gordon Growth Model, that links long-term dividend growth to share price appreciation. So tell me, Jonathan, what's it like starting your own fund? It's obviously not a simple thing to do.
Thanks again for having me on the podcast, Phil, and again, lovely to be here. Starting your own fund felt like a natural evolution. You mentioned my father. I grew up in a household where my father was a founder of a investment funds business himself and was one of the, let's call it, early pioneers of understanding this nexus between not just the merits of an investment, but the holdability or experience or how you hold that investment such that you're able to succeed. And so I grew up very much around this. In fact, from a very young age, I was an active investor participant in financial markets. And my father used to hand me thick stacks of envelopes all the time from a very young age. And it took me a very long time to really figure out why it was so valuable or so empowering. And I guess today one doesn't get the envelopes. It's all digitally. But the envelopes were basically just the dividend statements or the dividend checks of the companies that our family office was holding. And one by one, what you would see is that there's a company, it paid you a dividend, and then you would mark one, that it was received, and two, that it was meaningfully higher than the same dividend from the same company this quarter last year. And after you do this dozens and hundreds and thousands of times, you come to learn something very important. The dividend is really like a secret language that the company is communicating with its investor base. And instead of being glued to the price all the time, day by day, minute by minute, wreaking havoc over your emotions, you can look to this data point, which is extremely powerful and extremely informative to direct you to where you're going. And so as I was spending more time in the family office, really learning and honing our systems, I was approaching my 30th birthday and thought, I want to build this into a service for other people, not just for ourselves, because it was clear, all the academia is absolutely clear about this, that the investment return and investor return has a big gap. And we took the view that we're going to try to compound our own capital and our co-investors' capital by 30x in 30 years, my 30-year horizon, using this methodology.
This is incredible to me, hearing what it must have been like at the dinner table when your family's sitting around discussing these kind of things. Because I don't think a lot of people get this kind of opportunity in their families to benefit from such wisdom and knowledge. I mean, it's a great thing, and especially the idea of dividends as well being it sounds like almost force-fed to you.
It's funny that you say that. I remember sometimes going on business trips with the family. It was during school holidays, and so we would go on the trip wherever my dad's work was taking him, and you'd walk through the airport and there'd be, say, a bank branch next to a McDonald's, which at the time was a very important holding of ours. And I was educated, as you say, from a very young age, stand at the McDonald's, count the number of people, look at the prices on the board, and each time a burger, fries, a Coke gets sold, some tiny fraction of a cent is yours. And what you'd like to see is more of these McDonald's with more people there. And when it came to going to the supermarket and buying something like Band-Aids to take in your bag to cricket practice for your fingers, and looking at what the Johnson & Johnson Band-Aid price was, where it was in the supermarket relative to some competitor, you grow up understanding that a stock is not a ticker or just a certificate. You're a genuine owner of a business, even if you have a tiny fraction. And so you see the whole world through this lens of business owner, business participant. And it's an incredibly empowering kind of upbringing.
Okay, well, let's have a look at the basics. I mean, you've done a pretty good job there of explaining how, what dividends are, but let's just dig a little bit deeper. What are dividends and how do they work?
Good question. When a company earns, let's say, $100 in profit at the end of a period, the end of the year, they have a few different things they can choose to do with that. One thing would be to reinvest back into the business, open new stores, hire new people, invest in new products or advertising, etc. They can buy another company, a competitor or something like that. If they have debt, they can pay down the debt. They can buy back their own shares in the open market just the same way that we can, and then one's ownership percentage would increase. And the other option that they can exercise is to take part or all of that profit and pay it out to the shareholders. That's what you call a dividend. It's your share of the profit of the company that they decided, they being the senior management team and the board, which should get together at the end of the period and decide how to allocate this profit, and it is shared with you in cash.
That's a great explanation of, I guess, capital allocation, isn't it? Because that's what happens with it. And there's different kinds of companies that pay dividends, aren't there? Like there's a lot of growth companies and they're ploughing all of their money back into growing the business. And then there's others who might be sort of older and a bit more stable that will actually reward shareholders. Does that sort of affect the focus and the kind of companies that you're particularly looking at?
Very much so. You're right that the industry basically creates a division between dividend payers and non-payers. The non-payers are those that, as you say, are maybe earlier stage, higher growth. They take everything they earn and try and invest it back into growth. And then you have those that might be beyond their fast-growing days. They choose to or can't reinvest everything back in expanding the business, and they send it out to the shareholders. But there is actually a very interesting middle ground between those two. And coming back to our investment philosophy, there is a lot of research originally out of MIT in the United States, spearheaded by Professor Myron Gordon and his team. His team ended up winning Nobel Prizes. And now what they were trying to do was find the best correlation or the most determinative data point that would tell you where a share price is likely to go. What they found was, firstly, that companies that pay dividends as a category perform better in terms of share price or total return than those that don't. There are outliers there. This is not a rule for everything. It's just that the category outperforms the other category. And then they found that those companies that raise their dividend each year outperform those that simply pay a dividend. It makes common sense that if the profits that are coming out to you are rising, something good is happening, and usually when good things are happening, the share price tends to follow. And then they found that the companies that raised their dividend each year at the fastest rate outperformed the most. And then they canonized what is today known as the Gordon growth model, or a derivative of that is called the dividend discount model. And essentially what it says is that if a company pays dividends and grows that dividend over time, your expected annualized return for each year that you hold it over the long arc of time should be your current dividend yield plus the expected rate of growth in that dividend. Now, if you break down that formula, what you find is that if you can identify those relatively rare companies that pay a dividend but are able to grow it at a very fast rate for a very long time, you should get an outsized reward because the share price will follow that trajectory. It's not that dissimilar to, if I make it very tactile, if somebody is either collecting rent or paying rent to their landlord, and each year that rent is increasing by some number, if you're able to increase that effective rent at a very high rate, the value of that building or apartment or industrial complex is increasing at roughly the same rate.
So does this mean that a metric that should be of interest to potential investors is the dividend yield? I know that you can't just look at it in isolation, but if you were to look at the dividend yield of a number of companies, and there's many softwares that allow you to filter for these sort of things, and to also look at the growth of that dividend over a period of time would be a valuable exercise?
Absolutely. Most investors who think about dividend think about it in terms of their current income. That's completely fine. But it's not going to be the optimal way to deal with dividends. And that's because companies that have a high dividend yield or high current yield, they're priced by the marketplace in expectation that that dividend is not going to grow much, if at all. They tend to already be paying everything they earn out by way of a dividend. And if you pay everything out, that means there's very little left to reinvest in your business. So you're not going to be investing in better products, more stores, many more people, more advertising, etc. And so an investor who's purely focused on their current income, their current dividend, is kind of shortchanging themselves from the future, because if the dividend isn't rising as a signal that the company is becoming more productive, more valuable in its dividend paying capacity, the share price shouldn't rise at all or much. And if we flip that over and we say, irrespective of the current dividend yield, if what we focus on is the rate of change, because the rate of change is what influences the rate of change in the price, we're interested in the total return. So it's not a coincidence that most of our companies actually have very low current yields. Now, if you look at them over time, each time they grow their dividend, they announce a dividend increase of 10, 15, or 20% year after year after year, the market rewards them with a commensurately higher price and bring that yield back down for the new purchaser. So if we look at some of the holdings that we own in our fund, the yield today and the yield when the fund opened in 2019 is actually exactly the same, even though the dividend is double or triple and the share price has gone up double or triple, because the initial yield might have been seen as low, but it's no longer low. It's low to the new purchaser because this company is able to increase its dividend paying productive capacity.
Yeah, it's a valuable analogy. You're talking about a property, as in the rent for the property goes up, and then commensurately the value of the property will go up as well.
Exactly right. When people ask all sorts of questions, which would be typical when they're coming to buy a property, when they're thinking to be an investor, essentially all those questions boil down to, what are the prospects for the rent? Because that's going to be the determinant of the uplift over time. So is there a good school nearby? Where is the closest hospital? Is a new train station opening nearby? Is there an ability or a new regulation to build higher? All sorts of questions like that. What is the place across the road being rented for? All of these questions, if you boil them down to what is really being asked, it's how fast and for how long can I hike the rent? Because if I can hike the rent at 5% a year or 10% a year or 15% a year, the cash flow I receive at the end of every period is going to be higher by that rate. And therefore, what it's worth to me and to the market if I come to sell it is benchmarked against that rate. Now, in real estate, it maybe feels very tactile, but one building is roughly the same as the one next to it or the one next to it, unless it's a very unusual or very specific location. So that would be an outlier. And what we are looking for are those unique or special companies that have something special about them, such that they're able to grow their dividend at an unusually high rate for a very long time. Because one, that drives the price up at roughly that same rate over time. And two, like we said before, if you get your dividend statement, you feel much better about where this journey is going than just looking at the price. The price over, at least in the short term, feels a lot like a roller coaster, even though it's following the dividend. The dividend goes up like a staircase. If you chart it, especially in the kinds of companies that we own that tend to be in the United States and pay quarterly dividends, they'll typically pay a dividend which is the same, 4 installments in a row, and then announce the increase. And If you chart that, it literally looks like a staircase. And we're looking for increments step by step by step that are a healthy double-digit rate of change. And the price traverses the same path from point A to point B several or many years later, but the experience along that journey doesn't look like a staircase. It looks like a roller coaster riding the same trajectory. And so that's why we're so focused on trying to focus on this secret language of dividends that's telling you the most reliable clue so that you can actually hold and stay the journey rather than have this big gap between how the underlying investment does, which might have been very well selected, and how long you're actually able to stay along the journey.
Take control of your investments. ShareSite has you covered. It's Investopedia's #1 tracking tool for DIY investors. Get 4 months free on an annual premium plan at sharesite.com/shares for beginners. I know we're going off topic a little bit here and going off piste, so to speak, but what then is the way that you view the relationship between the price-earnings ratio, which is giving you a little bit of an idea of the value of a company, and the dividend yield? Is there a nexus, or are these forces acting against each other? Just explain that to me, please.
We think about them as two different ways to measure the price or valuation of a company. And actually, we look at both and many others. When we decide on one, what companies to own, and two, at what price, we use 120 different variables. We're always testing to make sure that our variables are giving us the answers or the conclusions that are productive and useful, and sometimes we add or change some of those variables. But coming back to one of the previous questions, over time, subject of course to significant changes in interest rates, dividend yields tend to hold roughly the same as do the price-earning ratios of any given company or even any given industry over time. So what we're looking to do is, one, find a company that is able to grow or compound its dividend at a higher rate. We use internally 15% as our objective, recognizing that if you aim very high, ideally you hit it, but even if you miss by a little bit, missing by a little bit will give you 12 or 13%, rather than if you just set the bar low at, say, 4, 5, or 6% and you miss, you end up with maybe 0%. So it helps to be ambitious in this. But what we look for is, one, once we conclude that a company is going to be able to grow its dividend at a high rate, we now need to know what price should we be paying. And we can compare its current dividend yield to its history. So we'll look at every single trade backwards over 5, 10, 15, 20 years and compare that also to the prevailing interest rate at the time so we can adjust for it. And the same will be true for the PE ratio. And what you find is, because over time the market does reflect the fundamentals, but the market is made up of emotional beings, and we're all somewhere along the emotional continuum of how much, let's call it, pain or volatility we can withstand before we feel forced to act. Very same companies sometimes will drift to very high price to earnings ratios, and the inverse, the dividend yield, would be to very, very low, meaning we're not getting compensated that much in cash today. And sometimes the reverse is true. And we're trying to buy these fantastic companies that meet all of our criteria when the dividend yield is a little bit more attractive relative to its history, relative to its competitive set, and when the PE is a little bit lower relative to its trading history and its competitive set.
How do you approach companies that might have a bit more volatility in terms of their earnings? And I'm thinking particularly of commodity companies like, BHP and Rio have been good dividend payers for a while as well, but possibly going down a little bit now. Sometimes these can be experiencing very, very fast increases in earnings and dividends as well. Do you tread a little bit more carefully with companies like that?
It's a very good question that you raise. We actually don't look at resources or commodities at all. And that's not because there is anything wrong or negative about the space. It's just that to be able to predict with a very high degree of confidence where a dividend is likely to go over the next few years, you need to be able to be in companies that aren't very sensitive to something outside of their control. world is a dynamic place. And if you are pulling something out of the ground, or if you're very sensitive to some price, let's say the interest rate that is beyond any given company's control, that means, as you say, that your earnings can go up very rapidly. Yes, through your own doing, but also through something that just so happens to be taking place. And the reverse is true, that when it falls or acts against you, that can be very destructive. And if you're in a program which is trying to psychologically attune you to stay the course in wonderful companies, it is not constructive, even if the endpoint, let's say in one of those companies that you mentioned, let's say the dividend today is 1 and in 10 years' time it's 4, which would be a pretty good outcome. But on that path, it's 1 and then 2 and then 0.5 and then back to 3 or 4. The data is conclusive here. It tells us that it's very difficult to stay on course because the feedback that you're receiving, both from the dividend and from how the market responds to that, is very difficult to continue with, which you need to be able to do day after day, not just to yourself, but also to the people around you who might be involved in the investment decision, a spouse, a parent, a child, etc. Now, contrast that with a company where it is doing something extremely predictable, where it's got an installed base of customers that choose not to or can't drift away, cancel their subscription because they desperately need what it is you're providing. It's seen as a standard. Often all of your revenues, and nearly all of your revenues, will be pre-contracted and recurring. That means that the volatility of your earnings is much lower, and therefore we can model out into the future with a much higher degree of confidence where the earnings are likely to be 1, 2, 3, 4, 5 years out, derive where the dividend is likely to be, and therefore actually chart that staircase rather than a roller coaster, even if the endpoint of the security would be the same. Let's say they compound over 10 years. And often when people screen backwards, they look at a chart, and because of the nature of compounding, dips don't look like much, but in the moment, they can feel like a lot. And so the larger the dip, especially if fundamentally your dividend is not tracking as you were hoping it to track, it's very hard to stay on course. So we look for companies that are extremely predictable, also ideally in areas that aren't subject to a high degree of technological change or much attention, such that the front page of the newspaper is dealing with it every day, drawing on our emotions. We tend to be in very dull, very boring, very predictable industries.
Yeah, other guests have pointed out that dividends often are quite less volatile, even when, a market might be going through one of its periodic dips, that dividends aren't affected as much as what the price action might be indicating.
That's exactly right. And we actually have a client who told me that for decades, he was so sensitive to the price of what he was holding, such that in the middle of the night, it's cold, it's dark, he goes to the bathroom, he can't resist but look at his phone to see the price, see the action, etc., which is not constructive. That's the opposite of trying to sleep well. And ever since he understood what we're doing and has been following our methodology, instead of needing to be across the price every moment of every day in different time zones, there are really only 4 key dates of the year, which is each time that dividend is announced, we need to compare it to the same dividend for the same quarter the year before. Is it higher? Yes. Is it higher by a lot and by what we expected? Yes. Fantastic. Now we can go and compare the price, but over time, not on any given day, because on any given day, the market might be very consumed by what is happening with the virus that is taking over the world, or a presidential election, or an interest rate decision. But over time, where the dividend goes, the share price follows. And it's almost like a sleep well at night elixir, because you don't have to be, at least insofar as our client or investor needs to be, they don't need to be glued to the price every second of the day. If the dividend delivers, over time the share price will deliver as well.
So you mentioned quarterly earnings and quarterly payments. So obviously you are invested in the United States. What regions, sectors, areas do you generally look for?
I mentioned before what we don't invest in, which are things that are very sensitive to prices or things beyond their control. We tend to be in businesses that are specialty niche distributors. What does that mean? It means being in large distributors of aftermarket parts for aeroplanes, or distributors of air conditioning equipment, or of specialty uniforms that need to meet certain standards. Installed bases of critical software, not necessarily the cutting edge that's front news of the paper, front page news of the paper every day, but things that have been installed into businesses, usually not such exciting applications that a business can't operate without. So, for example, software for billing for toll roads, or for productivity of school canteens in the United States, or ID badges for government institutions. Pretty boring, pretty predictable. Medical devices that have an installed base where either a wearer or a specialist kind of doctor has been trained on a platform for many years, and is therefore very unlikely to consider exploring an alternative rather than simply using more or the newest version of the same thing.
Are you starting off with the numbers, like you're sort of filtering in saying, okay, we're looking for numbers that satisfy these criteria, and then that throws up companies like these boring, dull businesses? Or do you look at the companies first?
I'm going to say it's both, because doing the former of simply screening to see what dividend growth has been is a very incomplete approach, because companies sometimes are able to grow their dividend for a long time, but then for some reason, either the industry is beginning to change, the competitive set is beginning to change, sometimes it's demographics, they're not able to sustain that rate of growth. And if all you did was simply screen, you would end up disappointed, because you invested in a company that maybe had 20, 30, or 40 years of very impressive high teen consecutive annual dividend growth, and then it slows down on you. And what you need to do is, that is one area, but that's just a starting point. You need to dig very deep into the company to make sure that its prospects, its reinvestment is both sheltered, that when when we begun this discussion, we discussed what is a dividend, and a dividend is what is paid out to the shareholder. The important part is also what is retained by the company. What we like to see are companies that, yes, they're paying out a small part of what they earn in a dividend that's rising. They're primarily taking their profits and reinvesting in their business very productively, in a very protected way, such that what they expect to earn on that reinvestment turns out to be what they expected to earn for a very long time. So their dividend paying productive capacity is going up. And that is a very detailed, one by one process of studying a company for quarters and years and sometimes decades on end to make sure that what you believe is true continues to be true.
It's an interesting point you make, because I think it's a criticism that's often been levelled at Australian banks, is that they don't reinvest enough. They're just paying out too much of their earnings to shareholders. And this is another interesting ratio to think about, is the payout ratio as well. Anyway, there's been two parts to that question, and I'll leave it up to you for your thoughts.
It's a very good question. And in Australia, particularly, let's say, with the banks, payout ratios for dividend paying companies tend to be high. Why is that? There are a few reasons we can hypothesize. One might be that we have a very developed superannuation system or retirement system, more so than most other countries, and therefore the dollars of the investor base maybe look a little bit different to other countries. It might be partly because of a tax system or incentive. We have franking credits. A lot of other places don't have franking credits. It might be a governance thing. We can't necessarily put our finger on exactly what it is, probably a blend. But the outcome is that in Australia, most companies that pay dividends tend to take essentially all of their earnings. Their payout ratio, which, just for your listeners, is the percentage of your earnings that you choose to pay out in a form of a dividend. So let's say you earn $100, and out of the $100 you pay out $70 as a dividend. Your payout ratio would be 70%, 30% is retained. To be able to grow your dividend at a very high rate, you need to reinvest most of what you earn in improving the productive capacity of this dividend growing engine. New products, new stores, more people, etc. So our companies tend to have very low payout ratios, 10, 15, 20, 30%. And in Australia, most of the companies that pay dividends have dividend payout ratios of 70, 80, 90, sometimes 100%. Now, if that is because they decided that they can't reinvest productively, they don't have the possibility of opening new stores, building new products, maybe buying other companies, then it's the right decision. That means that the company doesn't think it can invest and meaningfully grow, but it also means your dividend won't grow very fast, if at all, and therefore your share price won't grow very fast, if at all. And that's fine for a certain type of investor, but it doesn't meet our needs, especially if we come back to this idea of emotional psychology, where if you subscribe, and there are 65 years of overwhelming academic and empirical evidence of this, that where the dividend goes, the price follows. Psychologically, a dividend which is basically stagnant or constant doesn't do anything for you emotionally. Oh yeah, I received X dollars. I received X dollars again. Essentially, you become one that is hopeful that at least you continue to receive your X dollars, not less than X dollars. A much safer approach in our view is one where I received X, now I get 15% more than X. The following year, another 15% higher. And that is very much correlated with companies that are reinvesting very productively. There are very few of them in Australia that meet our size requirements, which is why we basically only invest in the United States.
Okay, so that's mainly the territory that you invest in, not on the ASX, the US only.
We haven't yet found what we're looking for on the ASX. If you simply look at the number of companies on the ASX that have been able to sustain a dividend that has grown every year for a decade or two or three, there are very few. And of those, there are very few who've been able to do it at a very high rate, anywhere near that 15% a year objective that we hold for ourselves. And fewer still of those are priced in such a way, coming back to your question about dividend yields and or PEs, because there are so few, the market rates them very, very expensively because there are so few. They kind of stand head and shoulders above their next best alternative from this kind of profile in Australia. Whereas in the United States, because there are more, you can often get a like-for-like exposure in terms of dividend growth history and potential, quality of management, ability to reinvest productively, etc., at a lower rating, and therefore it simply makes sense for us to do that. We're willing to explore, and we often look for companies on the ASX, but we simply don't find what we're looking for.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Okay, so let's run us through a couple of those companies that you've identified. I noticed Microsoft is one of them in your portfolio. Tell us maybe the Microsoft story or a couple of other stories you'd like to share with listeners and viewers.
Microsoft is probably familiar to every listener. There's a very high chance that they use some or many of their products. So perhaps I'll tell you about a company that somebody doesn't know.
There's been many people who've shaken their fist at Microsoft products, but you still have to use them.
That's part of the point, right? When any business receives their email or notification, either directly or through some IT consultant, that says whatever Microsoft product is now more expensive by 10%, there's basically nothing you can do about it. It's seen as the standard. It's too hard to pull out of your business. So there's enormous pricing power and enormous visibility into how this business is going to perform over time. So since not all, but likely all of your listeners are already familiar with Microsoft, perhaps let's talk about a different company. And we can talk about Cintas, which is one of our largest holdings. Now, Cintas is probably a less familiar name, and it doesn't ever make it to the front page of a newspaper. And Cintas is the world's largest provider of uniform rental solutions, fire safety, and first aid. What does that mean? It means that in the United States, somewhere between 15 and 16 million businesses need uniforms for their employees. They might be a quick service restaurant where in the back, in the kitchen, they need certain fire safety aprons. And for front of house, it might mean that they need a little branded hat and the right polo shirt, etc. And for a governmental organization like the fire department or the police department, they also have specialty requirements for their uniforms. Now, each one of those businesses has a choice. They need to meet certain standards. They need the uniform to be clean, reliable, available for their employees in every location. They can do it themselves, but there's a much higher risk of error, failure, non-compliance. Or alternatively, you can ask Cintas to do this for you. Because Cintas, founded in the 30s, it's actually a very interesting founding story. Cintas was started by Doc and Amelia Farmer. They were circus performers. And in the Great Depression, the circus basically stopped. People didn't have the discretionary funds available to go for entertainment. And
presumably there were still cops needed to kick hobos up the bum.
Now, what they, in a very entrepreneurial streak, figured out that there were lots of businesses that were discarding rags that were perfectly usable. They were just now used, mechanical shops and things like that. And they would go and ask, can we basically solve your waste management problem, or buy for basically nothing your disused rags? We'll launder them, and then we'll go and sell them back to the same business or other businesses. And over the decades and over the generation of the Farmer family, which still controls this company, they moved from disused rags to specialty uniforms. Now, Cintas today delivers specialty uniforms to about 1.1 million businesses that can't start their day without the uniform arriving. They are head and shoulders above anybody else in terms of number of customers. And that means that in any given geographic area where they participate, they have the highest density of customers, which means they can keep their laundries running more efficiently, and their vans dropping off every day are also more efficient, so they can price at a lower cost than anybody else, or provide a better service with a better reputation. And they don't lose customers. They've been able to grow their dividend every year since going public 42 years ago at an astounding rate of 19% a year compounded. This is not an interesting business from an exciting standpoint, but it is interesting in terms of its ability to keep growing, because they have grown from a handful of businesses to more than 1 million businesses that depend on it every single day. And they have added more verticals that you can sell in the same way through the van that's coming to deliver, because they establish this dependence relationship, or one of trust. And they started adding a few years ago fire safety, compliance, and first aid, things like the cabinets with AED machines, etc. Make sure that they're up to standard, they're up to code. If something needs to be changed, they're coming all the time. And Cintas pays dividend. It's primarily reinvesting back into the business. The incentives are basically set by the family, which controls the company. And the runway is enormous, because just in North America, they don't even have to leave the continent. They have the ability to grow from a bit more than 1 million to potentially 15 times the number of businesses. They will add more verticals. They will get more efficient. And that's a wonderful kind of story.
It's interesting, isn't it? Because a lot of people are looking for an exciting narrative when they're investing. And it's a little bit counterintuitive to be looking for the more boring companies. Are there any other boring companies you can share with us? Not the boring company, but...
Perhaps we can talk about Watsco. Watsco is the world's largest distributor of HVAC, heating, ventilation, and air conditioning equipment and components. Now, they're also family controlled and run 2 generations. The father, who was the longtime CEO, is sort of evolving into the chairman, with the son, who's now in his mid-40s, moving gradually into roles of increasing seniority. And they started as a distributor. Well, initially they were a manufacturer, but they figured out that it was better to be a distributor of systems and spare parts for air conditioners. Now, they're in Miami, Florida, where it's hot and humid basically around. And running your air conditioner is seen as a non-negotiable part of running a household or a commercial premises. And these systems sometimes fail. They actually fail very predictably if you look at a large enough installed base. And it's an emergency or near emergency to have it repaired. And if this has ever happened to you, what happens is you look for a technician and you call, and the technician will come and they'll look at your machine and they'll say, I need this part, I need this filter, etc. I will call my distributor or my supplier. And if they call the distributor or the supplier and they say, we'll get you the part in 2 weeks' time, you will call another technician because you're hot. Or in other parts of the United States, you're cold. And as soon as the technician says, oh, I'll come back at 3 o'clock this afternoon with the part, you say, fantastic. Go get it. Thank you. And Watsco figured out that if they could scale quickly in their territory, they would be able to have the best relationships and best terms with the original equipment manufacturers, your Carriers, Daikins, Mitsubishi, etc., who make the equipment. They don't want to sell into the household. It's kind of too personnel intensive. So they go through the distributor. As a distributor that had the best relationships, they could get product fastest, hold the broadest range of inventory, and build tools, increasingly online tools, mobile apps, ordering systems, predictive systems, so that the technician's job gets easier. So when they're standing in your house or in your office and you're hot, they can say, Watsco will have the part ready for me in 2 hours' time. As they grew and they scaled, they buy the leading distributor or they develop it themselves in expanding territories around the United States. Now, again, this is not an exciting business. But about 90% of the business are emergency or semi-emergency calls saying my air conditioner breakdown. And Watsco has been able to, since the Nahmad family took over in the late 80s, to grow their dividend at an astounding rate. Now, they often, at the back of their materials, say and show that while they are not an exciting business, they're not in cutting-edge technology and they haven't discovered a molecule that can fix a disease, they're distributing air conditioning parts, that they have been in the best 30 performers, the American stock exchanges, since they took over. And again, they went from a very small share up to the larger share. They have about 14 or 15% market share. There is a long runway to go. Taking just the last 25 years since the turn of the century, they have grown their dividend 108-fold. So $1 of dividend became 108, and the share price has done exactly the same. And while you are unlikely to ever find a newspaper or the TV business channel saying much about these companies, we think we can compute where the dividend is going to be with a high degree of predictability well into the future. We know because there's 65 years of academic and empiric evidence that shows that the price is likely to traverse the same pathway over time. And from a psychological or emotional standpoint, it is much easier to be an investor in a business that is providing air conditioning parts than one that is very sensitive to the latest technological development or the latest tariff announcement or some kind of government decree that may be positive or negative.
Or a resource company.
or a resource company.
As you pointed out.
Exactly.
So
right.
why do you advocate for heavier position sizing in high conviction investments? I mean, we're all taught that diversity is the key to safety and avoiding volatility.
It's a really good question. Now, if you come up with idea after idea after idea, you'll have to mark the degree of merit or confidence that you have. So in the last discussion of Cintas and Watsco, we've covered things like predictability, longevity, we touched on quality of management, etc. You're not going to have an infinite number of very good ideas. Good ideas are exceedingly rare. In fact, we have a small handful a year of that we think meet our requirements. And if you rank all of your ideas, it is likely the case that idea 1, 2, 3, 4, and 5 are better than idea number 100 through 105. It makes sense to concentrate your time and your effort on those that you think have the best merit, where you think you have the highest degree of confidence in the likely outcome. You are likely to know them better, because if you spend your time studying endlessly a smaller group of companies rather than an infinite number of companies, if your work is any good, you will know them more intimately. And so you can become more like that true business owner that we discussed at the very beginning, going to the McDonald's in the airport and being properly attuned to the business development rather than simply the price. Now, you do want minimum degree of diversification, which is why we don't hold one company. In our core fund, we own around 30. And around 30 also gives us a very important other thing, which we haven't really discussed yet. And that is, for our clients, we try and simulate or create the experience that I used to get with opening those envelopes. So we invested heavily in studying the psychology of feedback mechanisms, especially as they relate to investment. And each week, in fact, it went out about an hour ago, just looking at the time, we write to our investors a 1-minute bite-sized dividend progress update. Now, it doesn't come in the mail, it comes as an email, but essentially all it does is detail the most important developments during the week only through the progress of the dividend. So we'll say last week it said, this week Cintas raised its dividend by 15.4%. 15%, 15.4% is right in our wheelhouse. And 2 sentences about what makes Cintas special. In any given week, it isn't that meaningful. But if you compound week after week after week and quarter after quarter and year after year and soon decade after decade, what you find are people tell us that even where they own the same security elsewhere, the feedback mechanism is drawing them towards the most critical proxy that is universally understood. What a dividend is. It's tactile. It's very hard to tamper with. It's easier to adjust earnings, free cash flow models, etc. It's very difficult to tamper with the cash that has already left the company and is in your account. And so our clients tell us, and this is by design, that the holdability of these securities inside this framework, inside this paradigm, is vastly superior to the experience of holding them elsewhere. And actually, it extends their holding horizon, because it's just a matter of how much a company falls temporarily, often through nothing to do with it. It might just be some macro concern that won't be of any consequence to the company, but the price sometimes falls. And it's just a matter of extent before they capitulate. But when you focus their attention on the right thing, they're grateful for being able to have that much smoother ride. And you distill that down into a concept, coming back to income, that the safest income is a rising income. The faster it's rising, the safer it is. It's a very easy, understandable framework. So we need a certain number of companies, and all of our testing and research suggests around 30 is the number, which lends itself to each of your investments is actually meaningful. It's not an infinite number of ideas. It's sufficiently diversified between enough industries, and it lends itself to a frequency of reporting so that you get this compounding nature of, you see each of your companies every year raise their dividend on what becomes an almost every week basis. You will have that dividend increase if you have 30 companies.
So, how can listeners and or viewers find out more about DivGro?
We publish extensively on our website. People are free to join this mailing system, divgro.com.au. We see it as a service to improve every investor's emotional well-being, whether they're a client or not. We think it's very additive, and we're very thankful to people like yourself for sharing your platform with us to be able to educate and inform what we think is a very novel and very empowering framework to lift the ability for investors to actually get the compounding desires that they have, as opposed to looking at the merits of investment and not being able to actually stick with it.
And just quickly, what happens when you get Aussie investors going, where are my franking credits?
People who come to us understand that equation that we dealt with, which is your total rate of annualized return over time is equal to your current yield plus your rate of change. The yields of our companies are very low. They're growing very quickly in terms of our effective yield, even though the market keeps the yield at roughly the same rate. But they understand that the important part here is not the current income, it's the rate of change in the income. Such that if we can get the income, however low it starts as a yield, and some of the companies we've discussed, their yields are well less than 1%. It seems low. It's not for the income that we own them, it's for the rate of change of that income. As long as the dividend is growing at a very high rate, two things are likely to happen. One, the share price will follow at roughly the same rate over time. Tick, that's excellent. And two, your feedback is one of empowerment, of understanding, of moving forwards in an easy to digest framework, that they are able to stay the journey, stay the course, get the real compounding without having to worry too much about that current income, current franking credit that may or may not serve that same purpose.
Jonathan Nurick, thank you very much for joining me today. It's been a real pleasure. And Jen in the background. No one's going to see you here.
Thank you very much, Phil. Much appreciated.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.